believe we are live. Just make sure everything is working. Anybody's in chat, please let me know if the sound is good. On my end, everything looks good. So I think I'm just going to get this thing rolling here pretty quick. Today is going to be a little bit of a shorter stream. Feeling a little bit under the weather today, but I'm going to power through. Okay. The efficient market hypothesis. Thou shalt not beat the market. You shall not outperform the market. That is what the efficient market hypothesis says. We'll see about that. Okay. Just going to give it a little bit more time. Let a couple people filter in before we get going. I'll just review my material really quick. Okay. I think we're good. Okay. Let's go. The efficient market hypothesis. Thou shalt not beat the market. This is what we're going to be looking at the way I think, or one way. I think there's many ways that you can beat the market, but this is one of my recent experiments with this, and I think there is a lot of promise. So first of all, what is the efficient market hypothesis? Basically, this is an investment theory primarily derived by Eugene Fama's research. He says that the market incorporates new information so quickly and prices react immediately, so that there is no possible way that unless you have insider information that the stock market, that the broader market does not have, you cannot beat the market. That's what it says. In reality, there are three different forms of this theory. Number one, the weak form basically says technical analysis does not work because the price is going to react in the future to new information. And looking at past information cannot tell you what the future holds. So the weak form of this theory says that technical analysis does not work. However, it does say that there is a possibility for superior fundamental analysis. Now, that is primarily my realm, is fundamental analysis. So that is the weakest form of the efficient market hypothesis. The semi-strong form says you cannot win in fundamental analysis. You cannot win in technical analysis because everything adjusts so quickly. And then the strongest form is prices reflect everything perfectly. There's no errors at all. Now, I think the semi-strong form does leave a carve out for taking advantage of like an extreme panic where the market, you know, freaks out. People are selling emotionally. And if you can remain, a sensible investor during a panic, then maybe you can do better. But the strong form says that no, the market is absolutely perfect. If the price is dropping, people are not panicking, there is a legitimately good reason. The risk of holding those stocks is actually skyrocketing, and buying stocks at that time does not get you risk adjusted returns. So that is the theory. Hey Hokage, how's it going, man? That should be the title of the video. Thou shall not beat the market. Yeah, that's not a bad title. Maybe I'll change it. That's not a bad idea. Okay, so how do I get around this? How do I get around this idea that new information is so readily available to everybody these days that as companies release information, the stock market incorporates it immediately. Everybody buys and sells according, and there's no way that you can react faster than the giant hedge funds, the index funds, etc. Okay. My answer to that is low volume stocks. Low volume. Why low volume? Number one, if it's low volume, I mean, it's common sense. There's not many people trading that stock. There's not as much money going in and out. The price doesn't move as quickly to new information, and it is very prohibitive to the big dogs. Big investors cannot, like Warren Buffett, Berkshire Hathaway, cannot invest a reasonable chunk of their available cash in a low volume stock, because the act of buying the stock pushes the share price way up. And so they're no longer able to buy in at that really good low price, because the second they try to buy, it pushes it up. So how am I finding low volume stocks? A simple screener. The first step is a very simple screener. I've got market cap under 10 billion. Now this technically is getting me both mid cap, small cap, micro cap. It's getting me all three of those. It's excluding large cap and mega cap. I've got it filtered by industry, but I'm not excluding any industries. And I just want to see revenue going up at least 5%, gross profit going up, operating income going up, gross margin of at least 35%. And then I want an average volume of under 100,000. Okay, that is a low volume. And then I also wanted to look at price to book ratio. So I decided to filter all of these in ascending order by price to book ratio. So if you're not familiar with price to book, this is the stock price divided by the book value, all of the shareholder equity, the assets minus the liabilities that we have as shareholders. So if the stock price in the numerator is a small number and the book value, the actual assets minus the liabilities, is a very large number, then the price to book ratio will be small. So that's ideal for a value stock, is a very low price to book ratio. So I filtered these by low price to book, and I started looking at all these under 1. This is where I started my search. And I painstakingly went through all these companies and did a very quick free cash flow analysis. And then I'm not gonna slow play this. This is the company, DAC. It's Marine Shipping. This is the company I'm going with. And it looks, I'm really excited to look at this company with you guys today. It looks insanely undervalued. So free cash flow analysis, what does that mean? So free cash flow, that is the chunk of money that a company creates every year. That is my return on the investment. They use that free cash flow to pay out dividends, to perform share buybacks, to pay off their debt, or to expand their business organically or through acquisitions inorganically. So I care about the free cash flow. I want to see that it's expanding every year, and I want to see that they're putting that free cash flow to good use. So that is what I'm talking about. I use a discounted future free cash flow analysis. Now, Marine Shipping, I do want to say, it's a little bit risky. They are, in fact, we can go to really quick. Let's go to their investor relations. Sorry, no, not that one. Where did I put it? Here. Okay. So on their investor relations, I went to their latest annual report. And right here, this is one of the things they talk about, one of their key. They list all their key risk factors. I went down to this one because I think it's particularly relevant. If the global economic condition weakens, particularly in Europe, US, Asia Pacific region, it could have a material adverse effect on our business. So what kind of things are we talking about? We're talking about, let's see. We're talking about the trade war with China. We are talking about conflict. Where is it? There's so many. I've got it too zoomed in, or not zoomed in enough. Let's do it like this. We've got Ukraine. Oh, it's highlighting weird. We've got Ukraine in the Middle East. Things like COVID, things like the trade war, tariffs. All of these things affect the economy of global marine shipping. So a lot of these marine shipping companies have been depressed because of it's been thing after thing. We saw COVID, we had Russia, Ukraine, we had Israel conflict, lots of things going on that has affected marine shipping. So it is seen as a risky company. So we're going to keep that in mind as we are looking at this company, because it is undervalued. it is undervalued for a reason, but I'm making the case that it is just so insanely undervalued that I cannot pass this company up. That's the argument that I'm going to be making. And I would also point to their latest Q&A session as a little bit of a nice rebuttal to the concerns here. So this guy, Omar Nakata, one of the analysts, Omar Nakta, he is asking, we're seeing very high demands. Let's see, where does he talk about this? He doesn't really ask his question in the most precise way. Where was the bite here that I was looking for? Here, okay. I just want to get your sense in terms of what do you think is driving all of this kind of, I don't know what to call it, say a frenzy, but just a strong appetite on the part of liners looking for ships. So there's a lot of frenzy, a lot of people wanting ships despite everything that's happening. And John Kustas, he answers the question, what we see. So first he references the problems with tariffs. The tariffs themselves have not changed the overall world production capacity. And China during this period didn't stop producing. It's just that the goods were directed elsewhere. They're not going to the US. They are dynamically changing. They're not going to the usual Western areas, Europe and the US. It is developing elsewhere. So what does he say? The market is developing quite substantially all over the rest of the world. That is why also demand for mid-sized ships has been so robust, because there's really where the demand increase is coming from. So we're a very globalized world economy. If we have trade war with the US and China doesn't stop production. They start shipping stuff elsewhere, and then other countries end up doing that trade with the US. So it kind of happens more indirectly. So the economy, a lot of times, the world economy finds a way. So that is where this company, Danaos, ticker DAC, has had a nice recovery lately. If I go to the 5-year period since COVID, it has gone up 658%. Now, man, I wish I was aware of this company during COVID. Oh my gosh, that would have been nice. Even in just 2023, when they were at $54 and they've since doubled, it would have been nice to know. But the risk here, this was maybe deserved. Nobody really knew what was happening during COVID. A lot of companies really went way down. But anyway, that's neither here nor there. We're looking at the current share price and whether the current share price is justified. So I'm going to go ahead and pull up my spreadsheet. This is my automated free cash flow, discounted future free cash flow spreadsheet where I calculate the intrinsic value of companies. There are a few key assumptions that I have to make in order to do this valuation. So number one is the free cash flow margin. What percentage of their revenue are they able to turn into free cash flow? I typically will look at the historical free cash flow margin and extrapolate that forward. Now, I will also look at the revenue growth. There's a few different ways I look at revenue growth. I look at the past, see what have they been able to successfully do in the past, and if they're able to do that same performance going forward, what kind of discounted future free cash flow valuation would that imply? I also look at analyst projections for future free cash flow. That's number 2. And then number 3, I like to look at what is the combination of revenue growth going forward and free cash flow margin that would create the current share price being the fair share price. So those are the big assumptions. So in terms of revenue growth, there's 3 parts that I break it up into 3. I look at years 1 through 5, I look at years 6 through 10, and then I look at the perpetual growth rate. Why do I break it up into these 3? Well, typically analysts will only do a maximum of 5 years of revenue projections. So I stick the analyst revenue projections there. For perpetual growth rate, typically it's between 2 and 3, 2 being kind of the low end. This is the number I'm shooting for is kind of between the GDP growth and inflation. So somewhere in that range, companies will generally, if they're not going to grow at all, if they're not going to outpace the economy, which they cannot do perpetually, because if a company perpetually outpaces the economy, then it would dwarf the economy over time. So I typically like to keep it on the lower end. Perpetual growth rate in this case 2%, and then years 6 through 10. So for my initial assumptions here, we can see 2% growth in revenue, even though in the past 5 years they've had 17% growth. So I'm looking quite conservative here. And I'm wanting this discount rate. This is how much return I want every single year. So this is my target. I want to have an 8.25% return every year. Based on these assumptions, is the current share price high or low? Okay. So based on these assumptions, we see a 119% upside. That is a huge discount. So let's look at, are these assumptions really, like, are they actually conservative? Let's look at what the analysts say. Let's look at their past free cash flow margin and break that down a little bit and see, like, okay, because this seems too good to be true. That's a massive upside. And I'm putting in conservative figures here. The past free cash flow margin is 26. I put in 25. Their past revenue growth is 17. I put in 2. It looks too good to be true. So let's dive into this a little bit deeper. First, let's start with revenue growth. So where is it? Oh, did I lose it? I lost it. I'm going to have to pull that sheet back up. Bear with me. Well, for now, let's go to stockanalysis.com. I guess I don't actually need it. Never mind. So on stockanalysis.com, they have a forecast tab where analysts make projections. Now, this is a low volume, small cap company, so there's not a ton of analysts looking, but the ones that are say that it is a strong buy and that it's undervalued. If we look at revenue projections, the average revenue projection is basically flat. So 2% revenue growth for the next 5 years. Maybe that's not reasonable. Maybe 2% is a little bit too much. Over time, I think perpetually, we could expect to see at least this company growing with inflation because they have succeeded in growing over the long term. If I go to their financials tab and look at their revenue growth, if I go back 10 years ago, they were at $567 million in revenue. They've steadily increased. Now they're over $1 billion. That is what kind of increase is that? I did the calculation here. That is that's basically a 6% revenue growth over a 10-year period. So to say that they're going to be able to achieve a 2% growth going forward, I think it's reasonable. Oh, here we go. I remember where I was looking now. So this is Morningstar. I think, no, they don't do it on here. Shoot, I lost there was another tab that I had that had other analyst revenue projections for Morningstar. And unfortunately, I've lost that tab. Give me 1 second to pull that up. Bear with me. I had one more resource here to pull up some other analyst revenue projections, because stock analysis is not the only one. I apologize for the delay. I got to go to my Charles Schwab account. Charles Schwab has a lot of really good resources on analyst projections, some good reports. 411. Oh, jeez. Come on. Log in. Please forgive the lull in this video. This is important, though, to get a full picture. Sorry, I cannot log in. I'm not going to log in on stream. I'll just bring the tab over shortly once I have it up. Okay, but in the meantime... Oh, okay, here we go. Here we go. We got it. Research. Okay, I've nearly got it. So stock analysis says over the next 3 years that this company looks to be dropping revenue a bit. On Charles Schwab, I have access to another report. The LSEG Stock Report Plus. Let me pull it over. Boom. Okay. DAC, average score of 8, which is very solid. Let's scroll. They've got a buy rating. If we scroll down a bit, they give analyst earnings per share projections and revenue growth projections. So there is quite the spread on analyst projections for future revenue. So Okay, and actually it is. My apologies. This is roughly in line with the average analyst opinion for stock analysis. So they're going to be losing revenue over the next 2 years. They do not give 5-year projections on this company. So let's make this a little bit more conservative in terms of future revenue. Let's say that they're going to lose 3% for the next 5 years. They're going to be flat for the years 6 through 10. And then they will have a perpetual growth rate, a long-term growth rate of 2% thereafter. So given this new set of even more conservative assumptions, they still have a 64% upside. Okay, so revenue, I'm happy with the revenue being conservative at this point. Now let's look at free cash flow margin. So I have it at 25. What's going into that assumption? So there's a few adjustments that are being made here. So number one, sometimes I make adjustments for R&D. They don't have any R&D, so that's irrelevant. I will make adjustments for CapEx, acquisitions, and stock-based compensation. So number one, stock-based compensation, I count virtually all of their stock-based compensation against free cash flow. Generally, stock-based compensation push free cash flow up because stock-based compensation is not a cash expense. So this is me making it a little bit more conservative by counting 95% of all stock-based compensation against the free cash flow. Next, acquisitions. I'm not giving any credit for or against on acquisitions. Acquisitions have been incredibly low. Capital expenditures. This is the big one. Excuse me. This is a capital intensive company. The way that this company grows is by expanding their fleet. That is how they achieve organic growth, is by building more ships, bringing on more ships, chartering more routes. Okay, that's how they grow. So a portion of their capital expenditures is growth, and a portion of their capital expenditures is maintenance. So their ships have a depreciation schedule. So on their annual report, we depreciate our vessels on a straight line basis over their estimated useful economic lives. We estimate the useful life of our containers to be 30 years. So if they kept their fleet exactly the same and kept the same revenue coming in, and then it just increases with inflation on average, they're still going to have to replace one ship every 30 years on average. So that's going to be an expense. So they are building ships just to maintain their current fleet. So what is their current fleet? Let's see. What is their current fleet? So this was so I also want to show how they're growing here. So in February 28th of 2021, they had 60 vessels. In their most recent quarterly report, they have 74 container vessels and 10 dry bulk vessels. So they now have 84 vessels. So they've increased by more than 33%. And maybe 40% or so in the last 5 years or 4 years. So they're increasing their ships. So they are spending a lot of CapEx on growth. They're increasing their fleet size. So currently, I have zero credit for CapEx. This means I am assuming that 100% of their CapEx is maintenance. So that means that this 25.5% average is way too conservative. It is certainly, I need to be certainly giving them some credit for capital expenditures. 100%? No, that's too high. What a lot of people will do is they will look at the cost of depreciation and they will assume that, whatever percentage of the capital expenditures, whatever percentage is the depreciation part, if we compare depreciation to CapEx, the depreciation is roughly going to be equal to the maintenance, and the rest of the CapEx will be growth. If I take that and I use that method, that would mean that 63% of their capital expenditures is going towards growth over the last 5 years on average. So if I give them credit over the last 5 years for 63%, that brings their free cash flow margin up to 50%, because that means that there's a whole lot of cash flow that's not just being sunk into maintaining. That cash flow is actually being put to good use. It's going into organic growth. So if I now plug in a 50% free cash flow margin into the spreadsheet, oh my gosh. Now, even with these insanely conservative values here, we're seeing a 230% upside. And keep in mind, that's including an 8% return every year. So if I want to have an 8% return every year, my spreadsheet is saying that based on the free cash flow, the share price would be $325, which is just like way high. So in terms of free cash flow, this company is it's a free cash flow machine. That's what I'm trying to say. It's a free cash flow machine. So if I go to, and just to really drive that point home, that this company is a free cash flow machine, let's look at the ratios tab. So if I scroll down here to free cash flow yield, right here, free cash flow yield. Free cash flow yield measures a company's free cash flow relative to its stock price. Over the trailing 12 months, 19% free cash flow yield. Now, this automatic formula on stockanalysis.com, it gives a negative number because stock analysis counts 100% of capital expenditures against. So stockanalysis.com is not smart enough to separate growth and maintenance capex. So that's why this negative number is here. So all of these values are going to be lower than they're supposed to be, but they're just, stockanalysis.com is using the standard, the standard formula. So we've got an average of 19, -2. I mean, I guess we can run this math really quick. Let's go the last 5 years. Let's see what is their average free cash flow yield over the last 5 years. Let's just do the math. Damn it. 1, 2, 3, 4, 5. It's up and down because of the lumpy nature of CapEx, which stock analysis is not doing right. So this is too low. I'm going to say it again. What I'm about to do here, this is too low, but I'm going to do it just for the hell of it. So if I add all these 5 together, it is 114. 114 divided by 5. Average, it says $23. That's supposed to be 23%. Damn it. That's 23%. It's 23. Okay. It's 23%. So the average free cash flow yield over the last 5 years is 23% per year. So let's look at an all-star, badass company like NVIDIA. What is NVIDIA's free cash flow yield? Now, this is not a value company. The free cash flow yield, the price divided by the free cash flow is going to be very low. But I just wanted to put things into perspective because NVIDIA is a badass company, huge margins. I mean, they make tons of free cash flow, but their yield is 1%, 1%. So this is for a growth company, you're looking at low yields. This company, 25%. Oh my gosh. It's crazy. A simple Google search said, if I search what is a healthy free cash flow yield, 9 to 10% is excellent. 4 to 7% is healthy. It's generally a good spot. 1% NVIDIA, I would argue that NVIDIA may be overvalued. However, they've been growing like crazy. So that's why they're priced so expensive right now, because the market is considering that NVIDIA is going to grow a lot in the future. So people are willing to pay more for free cash flows now because they are expecting those free cash flows to grow rapidly. But let's not talk about NVIDIA. Let's talk about this company. My gosh, it's a free cash flow machine. So what are they doing with their free cash flow? How are they spending it? We already looked at CapEx. They're spending lots of money on their capital expenditures. That is growth right there. So let's go to their operating cash flow. This is how you calculate free cash flow. You take the operating cash flow and you subtract CapEx. Okay, that's the very simple way, but this is not taking into account growth. So let's just keep in mind that a lot of this is growth, okay? So they're getting all this operating cash flow. They're spending hundreds of millions of dollars on building ships. So they are growing their ships. Currently building more ships. Current ships under construction. I'll look at that in a minute, how many there are. So they are investing. They've got cash going out, investing in some securities. So they're growing organically. They are investing in some securities, short-term stuff most likely. In terms of paying off debt, net debt, it looks like so in 2023 they paid off $800 million, and then they paid off $100 million, and then they actually gained a bit of debt lately. But it's if we just look at the last 6 or 7 years, they've spent more money paying back debt, repurchase of common stock, and paying dividends. So they are buying back stock. They're paying dividends. They're growing organically. Excuse me. Yes, they could do better recently over the last 12 months. They have they have increased their debt by 71. But let's put the debt into perspective. Is their debt high? Do they have high debt? How do we evaluate that? One way I like to look at how high is their debt is I look at their interest payment and I compare it to their operating income. So if their operating income is 500 million and their interest expense is 41 million, that's less than 10% of their operating income. That's not bad. If I go to their balance sheet, we can see how much debt do they have. What is the actual number? The long-term debt is $675 million. How much cash do they have on hand? They have 600 million. And then short-term investments, they have 100. So they have like 700 million in basically cash. Current, this is cash, this is short-term investments. They have enough to pay off all of their debt right now. What does that mean for this company? A good filter that we can use in the future is net cash. This number, if a positive number is ideal. But their total debt, not just their long-term debt, their total debt is 752. They don't have quite enough cash to cover all of their debt, but they're really close. So the debt, I'm going to go ahead and say it, debt's not a problem. The debt is not a problem. So I'm not worried about debt at all. This company is a cash flow machine. Cash flow machine. So, okay, 63%. Maybe this is too much. We can agree that it's higher than 0. Maybe it's less than 63. I find it hard to quantify, honestly, going through their reports here. It's hard for me to know exactly what I should put as their growth capex versus their maintenance capex. But this is the closest I could come, this page right here. So this gives me the net cash used in investing activities. So investing activities increased by a lot in 2024, $650 million. What do they attribute that to? A $440 million increase in advance payments for vessels under construction. So the vast majority of this increase is vessels under construction. This company is building ships. They are building ships. So what do? I mean, even if I put in 0% and we just use the 25, right? We're still looking so good. Let's just leave it there. Worst case scenario, they don't get any credit for any capex. They don't grow. It's not reasonable, but still 64% upside. So finally, the final question is, what does the market think? Like, why is the market pricing this company so low? The market believes this company is going to lose revenue big time. Minus 10% over years 1 through 5. Minus 5% for years 6 through 10. And then if we say 1% into perpetuity, no, it's 1.5. Okay, that's about it right there. So the market believes that they're going to have low free cash flow margin. Too low. We know it's higher than this. The market believes they're going to lose 10% of their revenue every year for the next 5 years. The analysts don't think that. Then they're going to lose 5% for year 6 through 10, and then they're going to eventually stabilize with a perpetual growth rate of less than inflation. Less. So this company is going to be basically shrinking, essentially. If you're losing to inflation, you're shrinking. So that's what the market believes. Do we think this company can beat that? I'm investing in this company because I think yes. I think if we just put in -5 and we put in 2 and we put in 0, I think this is even lower than what the analysts expect. This is lower than what the analysts expect. And we get 50%. Now, forgive me, I'm ignoring these. The analysts, I don't have 5 years of high, average, and low, so I'm ignoring these. I'm only looking at my projection, and I'm looking at the past projections. And so if this company is able to perform as they have in the past 5 years, which, it doesn't seem like they will, but if they are able to maintain that past average, then a 283% upside, which is huge. So this company is just looking insane. So what I'm thinking is the market also thinks that this company is risky, that marine shipping must be a risk. If they lose a whole ship, if a ship gets bombed or blown up or whatever, pirates, you name it, stuff can happen. If the economy tanks, there's lots of things that can happen, right? So I'm not saying, we go out and we put a huge chunk of our portfolio into this company, but what I am saying is with a high enough diversification of these just home run opportunity companies, we can mitigate the idiosyncratic risk. We can mitigate the risks associated with a single company, with a single sector, with a single industry. We can mitigate those risks, but we can stack up the low volume, the small cap stocks that the market is just underappreciating. The market is not appreciating this stock because it's small. It's too small for the big dogs to invest in. It has too low a volume, and it's just not on people's radar. It's not sexy. Everyone's thinking about AI right now. So that is how we get past this efficient market hypothesis, is we look in the places where the market just isn't really looking. You know, if there's no volume, if the money's not flowing in, the stock price isn't going to move very quickly. It's not going to be affected. It's not going to be tracking perfectly with the intrinsic value of the company, which, when I'm looking at free cash flow, that is how I calculate intrinsic value. I look at what are the numbers? You know, what do the analysts think about the future free cash flow margin? How much free cash flow are they generating right now? Is there a reasonable expectation for that to continue? And then the numbers don't lie. You know, as long as this company can beat, what was it? It was -10 for the next 5 years, -5. And 1.5. As long as this company can beat that, then our return in the long term should be greater than 8.25% per year. Also, you know, and I just want to shout this out again. This is so low. This is way too low. It should be closer to 50. Let's split the difference. Let's call it 35. You know, the market, that's a 44% upside with this more reasonable free cash flow margin. So yeah, this company is just, it looks very good. We're going to be buying this company, or I'm on my public YouTube portfolio. I am buying ticker DAC on my public YouTube portfolio. Let's go ahead and pull that up. Let's do a quick review of the YouTube public portfolio. Hokage, if you're still around, I'd like to hear your opinion on this one. Do you have any opinions on marine shipping? Do you think it's too risky given, you know, the current state of the economy, tariffs, conflict? What are you thinking? Can we beat the market with this company? This company among many. Let's look at the portfolio. There's many companies we're investing in. This is just one. I have not invested in it today. I'm going to be investing in it first thing in the morning. Hopefully we get in at a good price. Bear with me while my M1 Finance app loads. That's where I'm investing in my YouTube public portfolio. And we can compare, we can compare my performance so far. This portfolio, we only started really in late December. So it's less than a year old, this portfolio. And this is a long-term mindset portfolio. This portfolio is buying stocks that are currently undervalued. And a lot of times the momentum is negative on these companies when we buy them. We don't try to pick the exact bottom of the market. You know, I'm not looking at technical analysis, and I'm having trouble loading this. Sorry. I don't know if my internet's bad. Hokage said, looks like a good find. However, shipping stocks do have some bad reputation with reverse splits and stuff. If you see 5 years before COVID, why did it drop so much? Let's look. Let me pull it up again. Why did it drop? Okay. Max. Yeah, so it was really high in 2007. And I didn't go back. I'm not going to lie. I did not go back and look at what the deal is with this company back in 2007. I don't know what happened, other than I can speculate that this had to do with 2008 financial global crisis. You know, that, I mean, let's be real. That's probably what happened. You know, 2008 global financial crisis, boom. And then it's been bouncing around ever since. It has not, if we go back, you know, to 2010, you know, it's not much higher. It hasn't gone up much in the last 15 years. But since 2020, 5 to 98, if we look at 2022, since the most recent short little bear market, it's doubled since 2023, I should say. So there has been some recent movement. And remember, I'm not a technical guy. I'm not looking at the technicals. I'm not really caring so much about how much this ticker has moved in the past. I'm looking at what is their trajectory right now. That's what I'm looking at. Project says, that makes sense. Yeah, I think, I'm just throwing that out there. I think it was 2008 financial crisis that did that. Yeah, I mean, this company, free cash flow, it's crazy. It is absolutely crazy. Oh yeah, is my M1 gonna work? Jeez, I keep trying to load it. Okay, we're up and running. Let me pull it over. Okay, M1. So this is the year to date. We are slightly being edged out by Vanguard Total World, but let's compare to the S&P 500 because that is my benchmark of choice. I'm investing in a different company every week. We're eventually going to have 500 stocks. No, I don't think I'm going to be. Just kidding. I'm not going to get up that high. So my YouTube portfolio is up about 21. The S&P 500 is up about 17, 18. So we are still edging out the S&P 500. Take that with a grain of salt, though, because short-term returns are not what I'm after. When I'm investing in a company, a lot of times it has negative momentum when I buy it, and momentum is a real thing. I'm not trying to pick the bottom. I'm not waiting for it to turn around before I buy in. I'm doing my analysis. I'm typically trying to wait until after a quarterly report comes out. I don't want to invest right before a quarterly report. I've made that mistake in the past. That feels a little bit like rolling the dice because I'm investing right before a whole bunch of new information comes out that I should be incorporating into my decision. So try to wait, get that quarterly report information or annual report, whatever's coming out, and then look at the numbers. And if it makes sense, I pull the trigger. So that's what I've been doing. When we had very few stocks early on. See, remember, we're buying as we're adding stocks to this portfolio, it's starting to get more and more correlated here with the S&P 500. But over time, if I do a good job of picking companies that have more future free cash flow reasonably than what the market expects, then we're going to do well. Okay, let's look at the different companies really quick. So we have how many different companies? 41 different companies, and it's about to be 42. So yeah, we are. And also I want to make another disclaimer. I'm not set for people who are stock picking out there. There's a lot of different ways that you can set up your portfolio. You can have, say, if you are not willing to put in a ton of work into analyzing companies, then maybe just keep 10% of your portfolio for stock picking, maybe a small percentage, and then just a few stocks in there. The more stocks you invest in, the more you have to keep up with. So this is not what I'm doing is an exercise. It's not necessarily the ideal way to invest because it is difficult for me. It's impossible for me to stay up to date with 41 different companies to the level that I should. So this is an exercise in analyzing a company, showing how I do it, and pulling the trigger, investing in it. And then we're going to try it after I've held a company for a year. We're going to do a review on the company and see if I still want to hold it. That way, if I feel like it's grown a lot and it now has its share price is beyond its discounted future free cash flow value, I can sell without experiencing short-term capital gains. I can have long-term capital gains if I wait a year. And I just don't have time to check all these companies every month. And if you're going to be picking stocks, you want to with the companies that you're picking, you want to pick few enough that you can keep up with them, but you also want to pick enough to have some level of diversification. And there's not like a hard line that's like the right answer for everybody. It's a spectrum that you have to find that answer for yourself. So I just want to throw that out there. I'm not necessarily advocating for you to do what I'm doing. The educational benefit here is in the process of finding the company, analyzing the company. And so I'm just showing a different company every week. So 41 different slices, about to be 42. I've got it organized by best performers on top, all the way down to worst performers on bottom. And we've had some bad performers, but of these bad performers, some of these I think are really strong companies. CoreWeave, I don't know though. That one's a little bit more speculative. But yeah, these are the lowest performers. Airbnb, I think this is one that I may be doubling down on. I think Airbnb is a wide moat, free cash flow generating machine. Oh, and that reminds me, I didn't look close enough for our our company of the week, Danos Corporation. Been doing well over the last month. I did not look close enough at their share repurchase program and their dividend. So currently, their dividend is 3.65%. That's a solid percentage. Their share buybacks. What does their share buybacks look like? So their shares outstanding has been decreasing every single year. So in 2020, 2020, this was COVID. They issued a lot of shares going from here to here. So they experienced a lot of dilution in these 3 years. That's bad. I don't like to see that. They had to issue shares, diluting their shareholders to raise cash. Over the last 5 years, they have been consistently buying back those shares and increasing the voting power of each share that you hold, increasing the ownership of each share that you hold. So this is what I like to see. Really good share buybacks, solid dividend. Okay, Max, what do you think when the best time to trim the portfolio, especially when a lot of people are talking about AI bubble busting in 2026? Great question. Best time to trim the portfolio. So, I was talking a little bit about this before. I really think you have to go company by company, in my humble opinion, and do a discounted free cash flow evaluation on that company and see, does it still appear to be undervalued right now? And if it appears to be overvalued, does the tax hit make sense? Because when you sell a company for a gain, if you're making lots of transactions and you're getting short-term gain, those tax gains are cutting into your profit. So you have to be confident enough when you sell. If you sell for a gain, you have to be confident enough in whatever else you're buying. So you're going to take that money out of the one company that's doing well. You're putting it in a different company, and you have to be confident it's going to outperform greater than the tax hit that you're receiving. So you also that makes it complicated. You got to take into account how much, whatever tax bracket you're in, that is cutting into your gains on your next stock, because if you didn't pull it out, you wouldn't have to take the tax hit. So that's what I do. When I'm looking at in my personal portfolio, which I keep track of more closely, I am checking the discounted free cash flow valuation of every company that I have larger holdings in and seeing, is it overvalued now? That is how I decide to trim. It is just the same exercise again and again. Is it overvalued? Yes or no? I hope that answered your question well enough. Hokage, Moneycessity 100 index or MB 100 index. That's not a bad idea. We can make an index. Maybe we can get up to 100. We'll see. Well, I don't know. I haven't really set a goal for how many stocks I want to keep it to. 52 sounds right, because if I'm investing in a different stock every week, on average, we get it up to 52, and then you trim at a year or something, or you buy. I don't know. Maybe 52 could make sense. But I haven't put much thought into that. Hokage also says, I noticed that out of all of the tickers, AGI, BTI, some of the healthcare stocks are acting as hedge when tech stocks have bad news in the market. They're uncorrelated, which is a good diversification. Yes, 100% you're right. And I do agree. It is important to make sure that we are investing in different sectors, different industries. We don't want to just, if I decide that there's 10 companies I want to invest in as an industrious stock picker, where I'm spending lots of time and I have a portfolio of 10 companies that I'm just, intimately know, it's probably not a good idea to have all of them in the same sector, especially if those individual stocks are a large portion of your portfolio. Hey, in a donation from Max, $9.99, that might be the largest. No, it's not the largest, but that might be the second largest donation I've ever received. Very generous, Max. Thank you very much, man. I really appreciate that. Can I heart that? How does that work? You got the heart. Hokage 52 makes sense. If you knew earlier, you could have separated it as large cap, mid cap, small cap growth. Yeah, and I should. I need to stop being lazy and separate these companies in a way that makes sense. Because right now there's no organization. It's just doing well versus not doing well. So I should be putting these into different slices. is my pie right now, and it is not looking not looking good. I need to organize this, and I think I can even after the fact. So I think having a pie for small cap, low volume stocks is a good idea. And then also having it organized by sector is also a good idea. So maybe like a couple different styles of organization. Oh, Max, bro, that is not necessary. A $50 donation. I should not have commented that you weren't the highest donation. I hope I wasn't like, I hope you didn't take that as I was baiting you to be the top donator, but that is very generous, man. Wow. $50 donation. Thank you. You don't have to do that, but I do really appreciate it. That's wild. And I think a good note to end the stream, unless somebody has some other questions, some other stocks that they want me to look at for the next video, I'm always down to do a quick analysis of a stock that a viewer wants me to check out. Always down to do that. I can do a very quick, with my spreadsheet being automated as it is, I can do a very quick surface level discounted free cash flow analysis, just throwing in the analyst projections. And we can come up with a pretty close, ballpark analysis. Oh gosh, hey, with the $10 donation, bro, that you don't have to do that. I do. I really appreciate it. That's very generous. Yeah, I don't want y'all to feel like you don't feel pressured to donate. But yeah, thank you so much. This $60, $70 is going into the YouTube portfolio. We will do we'll do some more a higher investment this week because of that. Thank you so much. Thanks. I have profited from your stock analysis. A small thank you. Hey, dude, I am so happy to hear that even though they are short-term gains so far, I'm glad that you have profited. It is certainly better to see short-term gains instead of short-term losses. But yeah, just remember this: we are in this for the long haul. The stocks that I am picking, I am not looking at technical analysis at all. So I am not making any predictions on short-term gains. So just please remember that. But yeah, I'm very happy that your stock picks have gone well so far. I appreciate all of you guys. And on that note, we're going to sign out for the next stream. Every Wednesday around 7 to 7:30 is when I typically shoot for. If you have any companies you want me to look at, please let me know. And we'll catch you guys next time. And we are going to ignore the efficient market hypothesis. Okaji, I really liked your suggestion for the title of this video. Thou shall not beat the market. Max says, literally have a portfolio on Robinhood named Moneycessity. Wow. That's awesome, bro. Thank you. All right, guys. I appreciate everything. Really, you guys are too generous, too kind. I'm feeling very blessed to have you guys watching, and we'll see you next time. Good night.